To our markets panel, Investmark Advisory Group Principal Michael Lee and Fairfax Global Markets CEO Paul Dietrich. You know, Paul, you pointed out as we come to the close of Q1 here that we've actually now gone a full 12 months, a full year without a correction in the market. You think a correction would actually be very healthy for long-term investors. Explain.
I do. I think we've gotten a little ahead of ourselves. If you look at the PE now, it's over 17. The average 5 years is 15. So I actually think it would be very, very healthy to have a little pullback and a little rest. But the point that needs to be made for investors is that the underlying fundamentals of this economy are really quite good. And you look at earnings, they're quite good, and projected earnings are very, very good. So I think overall, this year is going to be an upward trend in the stock market, but it wouldn't be a bad thing, I think, to have a little bit of a pullback and revert to the mean.
Mike, but you don't think that stocks are that expensive here?
Well, so long-term average, the S&P 500 right around a 14, and 99 right. We got to 24. So definitely higher than the long-term average, but if you look at the chart, you're either way below it or way above it, right? And what I would say is there's less risk in large-cap U.S. stocks now than there ever has been if you view risk as a balance sheet, from a balance sheet standpoint, in that we have the cleanest balance sheets we've ever had. So typically towards the top of a market or the end of a market, you see all sorts of corporate hubris and all sorts of over-leverage. We're not in that situation now. I would love a correction to be able to buy cheaper. I just don't know if we're going to get it.
You know, everybody always says they want a correction, and it's great, and you want to be a buyer in the correction. But, Paul, when it's actually happening, investors panic. They get worried. What's the solution? So if we do get this pullback, we get an 8% pullback, what do you want to tell the viewers that they should be thinking about so that they don't get crazy?
Well, I think Warren Buffett said it best recently, that the market basically benefits people who have patience. The people who have patience win. The people who don't have patience lose. And that's the key. There's one other thing that's happening in this market, and I don't know that people understand this, is that, I mean, most people, especially the people like me who live in Washington, D.C., we do believe that regulatory reform is going to happen. We do believe that tax reform is going to happen. We do believe there'll be an infrastructure bill, even probably more Democrats voting for it than Republicans. And if that happens, which I think is a high probability, we're going to have earnings that are going to go through the roof. I mean, just even if you cut the corporate tax rate, the money saved goes into earnings. And so we've been valuing on a PE basis the market based on what we all know right now. But we're going to have to revalue when all of this stuff takes place. And if we do get higher GDP growth, the PEs are going to be different.
You know, Mike, Paul mentions Warren Buffett. Warren Buffett also advised investors about a month ago to go into index funds. And I read a piece in the Financial Times on Friday morning that there's almost been about $1 billion net going out of active funds daily for the last month into index funds. Now, that's something that worries me longer term, how much money is being indexed. Is that something you're concerned about, and is that something you advise investors to do?
So it's very, very hard for active managers to outperform their benchmarks, right? And it's a lot. If you're an investor, if you're a retail investor, and you're just doing some sort of asset allocation, just going into the index, you know, you save on cost. So if you miss out on some sort of outperformance, you know, that's over a couple of years, you may be saving 50 basis points or 100 basis points. So I'm not really worried about it. I think the more that goes to indexing, the more inefficiencies will be ignored, because right now we're in a situation where alpha or excess return generated by managers is so small, and the people that were good generators of it have so much money that this is a natural progression. And then I think the pendulum went from one way, all active management, no indexing, to the other side, and then this will actually, I think over the long term, this will bring that back.
Well, thanks to Michael Lee and Paul Dietrich.